right. Hey, good afternoon, everybody, and welcome to this episode of Trading Views. Very excited to have with us today's guest, someone that we've always welcomed into our homes and our places of work every Monday and Friday morning. He is a longtime supporter of not just our industry, but for those individuals who kind of stand the wall and man the front line on trading desks all around our nation. Of course, I'm talking about CNBC reporter Bob Pisani. For those that don't know Bob, he's been a reporter since 1990. He's covered Wall Street and the stock market for over 25 years. Bob has covered the real estate market for CNBC from 1990 to 1995, and then moved on to become a stock correspondent in 1997. Bob has a new book out. I was fortunate to get my hands on a copy of it. The book is out. It'll come out publicly October 18th, so please pre-order it on Amazon. It helps for a lot of these stats that they use as far as picking, bestseller lists and stuff. But the title of the book is Shut Up and Keep Talking: Lessons on Life and Investing from the Floor of the New York Stock Exchange. Bob, thank you so much for taking time out to spend time with STA and its members. Love to dive right into the book here. So why don't we just start with just some general background on the book? Like, how did it come to be? The decision making around how you organized it is, I think I'm curious about that, because obviously most books, they're either telling a story or they're giving financial tips. You made the decision to kind of walk both paths. Would like to understand kind of what your mindset was on that. Were there any risks around it? And with that, I'm going to turn over to you.
Yeah, thank you, Jim. And I'm happy to be chatting with you. I've had a 20-year relationship with the Security Traders Association, including with you. And it's a great honor for me to be part of the organization and participate in it. About the book, I have had a very privileged position here. I've been stocks correspondent for 25 years for CNBC. And those of you who don't know a lot about journalism, that's very unusual for someone to have a single position. Normally, journalists kind of move around in their careers. If you work for, a newspaper like the New York Times or the Washington Post or the Journal, you're probably not covering the same topic for 25 years. I have stayed here because I love the New York Stock Exchange. It's a very privileged position to be down on the floor, to watch the IPOs, to watch some of the trading, particularly in the 1990s when the floor was very, very powerful. So working at first off, very privileged to be at CNBC, but second, privileged to be on the floor and to have seen so much in 25 years. And now that I've been getting older and, I hit my 25 years on the floor, I started thinking, what do I really know about the markets and investing? And then you get into more existential questions like, how did I come to believe all of this stuff that I think that I know? And who taught it to me? And is it still true? And you get into all these questions as a journalist. And I wanted to do something as a sort of summary of what I have learned down here on the floor. So I met with the publisher, Harriman House, very respected financial publisher, and they were interested immediately. And they said, we're interested because you have that very unusual position of actually being on the floor. And those bell ringings, there have been 10,000 bell ringings in 25 years, all these people you've met. First off, we don't want you to write a memoir, but tell us some amusing stories about people that you met. Tell us some famous people's stories. Tell us stories of somebody who said something to you that was very poignant or interesting, or somebody you didn't expect to say anything that said something interesting. We don't want a memoir, but we want you to tell us a little bit about what you experienced on the floor. They also said, we don't want you to write a strict financial history, but we understand you're going to interact with financial history and you're going to explain that. So the book is a little bit of a blending of a quasi-memoir and a little bit of financial history, particularly since the early 1990s. People ask me about the title, Shut Up and Keep Talking. I was talking to the publisher, and one of the things people are always interested in is the mechanics of television. How does it work? How do you decide what you're going to say every day? How do you interact with the producer in a control room that's not even there with you? So I have these things called earpieces. These are IFBs, is the technical word. It means interruptible foldback. Don't even ask how they got that title. But you put it in your ear and the producer talks to you. And people always are interested, well, how do you know when you're coming on? What do you say? What do they say to you? And normally, well, you can have all sorts of conversations with producers if you want. Typically, there's really two commands from producers that you'll hear. One is the word wrap. Wrap means basically shut up, stop talking. The other word that you'll hear is stretch. stretch means keep talking and keep going. So while you can have all sorts of conversations, the basic things you hear from producers are the commands, shut up and keep talking. And the publisher said, that's it. That's the title of the book. Shut up and keep talking. So that's how the title came about.
I didn't know that. That's funny. That's funny. Well, I got to tell you, the blending that you talked about with the stories and the insights, the stories, and also the advice. I think the blending works. It definitely keeps the reader's attention and kind of gives them a much more fulfilling and rewarding experience in reading it. So why don't we dive into a couple of the things that you do cover in the book? So you do devote several chapters to explaining why everyone is just so bad at predicting the future. I mean, and not just stock pickers, but the Federal Reserve analysts, especially strategists and forecasters in general. I mean, well, why is the future just so unknowable, and why do we have such a poor track record? It seems to be getting worse, by the way, not better.
Yeah, we just had the new SPIVA numbers out on active stock picking, and there's, on a long-term basis, they're as dismal as ever. It's not just stock pickers. Not amateur stock pickers are bad. Professional stock pickers are bad. Economists are bad. Analysts are bad. Strategists are bad. Almost everybody is bad at predicting the future. I mean, if you don't notice that, you're not paying a lot of attention. And believe me, it drives people nuts. It drives me nuts. Like, how are we supposed to report this analyst says this? Well, we know long-term, the majority of analysts get it wrong. So it turns out there's something about the future that's fundamentally unknowable. And the first problem is that the predictions are riddled with biases and noise that you find hard to identify, but definitely exist. We can talk a little bit about this in a few minutes in behavioral economics, but the first problem is there's biases and noise in the prediction that make them unreliable. But the really big problem is just that the complexity of life. There are too many variables to make accurate predictions. We don't have complete information. Events occur that are unpredictable and could change the outcome. Just think about an analyst who's trying to predict where a stock price is going to be 1 year from now. You might think this is easy. It turns out it's impossibly difficult. Why? Because every company has millions of different variables, each of which can affect the outcome. So some factors are predictable, some aren't. Just on the big level, the economy could change. We could have new shocks and surprises. Who thought of COVID? Who thought of a conventional ground war in Russia with the Russia invading Ukraine? Who had that? How about a cyber attack that comes out of nowhere? You may have a new competitor. You may be bought. You may have a merger somewhere. The CEO may change, and that's another thing. Humans are not predictable either about the future, their own future. So making predictions about what human beings are going to be like in a few years is difficult because think about it. Some people do well, some people don't. Some people have mentors that guide them. Some people get illnesses. Some have failures. Some have personal events. You get the point here, Jim. You think that you can figure things out, but there are so many variables that go into determining an outcome that it's really, really difficult to figure out. It's kind of like that old metaphor about the butterfly flapping its wings in Africa, and it creates a disturbance in the air pattern that eventually leads to a storm in the Caribbean. Little tiny variables can have oversized impacts. And so when you look at this on a systematic basis, and there are people who have looked at it, there's a fellow named Philip Tetlock who wrote an amazing book called Super Forecasting, where he looked at why people were so bad at this. And once you understand what can go wrong in the forecast, you understand the biases and the complexity, you get a lot more humble. I used to get really annoyed at analysts and strategists, stock pickers, they're terrible. And now I kind of understand, they're not stupid. They're trying, and often they have the best information available. It's just not enough to really make the accurate information.
Yeah, I mean, listen, I always found, first off, I like the fact that you just don't make the statement in the book, what you just kind of talked about. You really do back it up with a lot of stats and a lot of numbers to kind of really drive home the point. And I did find myself kind of just, in my mind, as I'm reading that part of the book and thinking about, every time you have a position in the stock and the news would come out, and then obviously the salesmen all jump up and they say, is it good or is it bad? And it's like, even when you have the information, you don't know how things necessarily respond to it. Good news, bad news, who knows, right? It's that old proverb, that. But so why don't we pivot towards, because you did kind of touch on this you do spend a lot of time in the book talking about behavioral finance, and obviously a very timely topic given the whole meme stock craze that we're kind of going through, and also even just the how our regulator, Chair Gensler, is looking at firms and how they are interacting with clients online and stuff. So first off, why don't you just talk about, like, what is it? What is behavioral finance? And why did you feel it was so important to dedicate so much of the book to the topic?
Well, if there were three things that I really saw that were really important in the last 30 years that I thought was really moving, was number one was the growth of electronic trading, which is an example of a disruptive technology. The second was the growth of indexing and passive investing. And the third was the growing awareness, particularly in the last 20 years, of what we now call behavioral finance. And behavioral finance basically aims to study how human beings really act, not how they're supposed to act. So if everybody's supposed to buy low and sell high, why don't people do that? Actually, they don't. They buy high and sell low. Why? If we know that that's not a rational thing to do, why do people act irrationally? And Robert Shiller wrote an amazing book in 2000 called Irrational Exuberance. He's one of the fathers of behavioral finance. And years before that, he had done a study that indicated that the volatility of the stock market is much greater than would be explained by simple fundamental analysis. And he posited there is something else going on here, because if the market worked on strictly fundamental analysis, it wouldn't be so volatile. And he posited that there was a somewhat irrational component to investing that was causing the increased volatility. And that was an early, that took back almost 40 years, study on behavioral economics. So basically, what's happening here is you have biases, and you have biases that are emotional biases, where people think wrong, and then you have emotional biases where people feel wrong, and then you have cognitive biases where people think wrong. So here's an example of an emotional bias: loss aversion. People fear a loss a lot greater than the expectation of a gain. So they'll hold on to a stock for much, much longer because they can't bear to actually sell the thing. Some people come to believe they're infallible when they're on a winning streak. Look at this, I'm up 20% this year. That's called overconfidence. Some people just blindly follow what others are doing, don't even think about it. That's called herd behavior. These are very well studied. Some people value something that they own above its true market value. That's called the endowment effect. I'm not selling my stock. I'm not selling my car for less than $50,000. It's an old Chevrolet, and darn it, I'm not taking $40,000. Because they own the car, they think it's more valuable than it really is. Then there's these cognitive errors where people have, they just think wrong. So for example, people jump to conclusions based on information they have. People never consider, well, maybe the information I have is really limited. Maybe it's not even accurate, but they'll jump to a conclusion based on a stat or something they read in an article and make an investment based on that. That's a real serious problem. They'll select information that supports their own point of view. They don't care about what other people think. That's called a confirmation bias. I can go on and on. There's dozens of these that have been studied, but behavioral economics attempts to categorize this and show how people's biases influence what they do in the field of finance. And of course, you can take this into virtually any endeavor, interactions with other human beings as well. But the central point is there is a somewhat irrational component to the investing part of this. And once you recognize it, you get better at understanding. Like, it's not such a mystery to you. Like, my heavens, why are people, buying low and selling high, or buying high and selling low? The opposite of what they're supposed to be doing.
I mean, listen, I thought it was some of the more insightful things that you had in the book on it. I mean, obviously what you're kind of talking about goes way past the two main emotions that we always would, talk about on Wall Street: fear and greed. This goes way, way deeper than that. And I think it also, at the end of it, where you kind of wrapped it all up, was it really made just a really strong case as to why we should allow other people to manage our money, at least portions of it. I mean, obviously some of us can control some of these emotions, and there is some enjoyment in us doing this. But at the end of the day, a good chunk of your money really should be managed by somebody who does not have that emotional attachment that you do.
The question is, that's a good point. The question is, yes, However, that person managing the money also probably has biases as well. So here's one of the things that came out of behavioral finance. It gave a big boost to the passive indexing crowd, because the crowd of people who came to believe behavioral finance was correct said, wait a minute, I mean, I'm not going to endlessly analyze myself for my own biases, but I'm also not going to endlessly analyze other people for their own biases. So just passive investing, index investing made sense because it reduced or eliminated a lot of those biases. You're just going with the market. So that's one thing that happened as a result of behavioral economics, particularly after the great financial crisis. Indexing went up because of that. The other thing is sort of people debating, so does this mean because people act irrationally that stocks are mispriced? And I think, well, I don't know. Yes, it's maybe not always true that a stock price is equal to its intrinsic value, its fundamental value. And I think people have to get comfortable with that. The other thing is, people ask me is, well, why can't we train people to think more rationally? Wouldn't that make sense? And I think the answer is yes. And if you're interested in how to do this, Philip Tetlock's book, Super Forecasting, talks about training people to think better and acknowledge and reduce biases is really a key, and how to think more openly. Open thinking is really a big thing. You can't be too close in the way you think. So I think the problem is this: you can train people to think more rationally, but I say in the book, don't expect too much. And I say this as somebody who's been watching down here for 30 years. The problem is, number one, investing wisdom is very much in short supply because financial illiteracy is very widespread. It's Jim, you know this. It's amazing how little people know about anything and how easily influenced they are. So number one, financial literacy is still widespread. And number two, even people who know better continue to make dumb mistakes because overriding this brain's tendency to act first and think later, it's very well ingrained in our brain. In the book, I document my own stupidity just to show you my own investing mistakes, where I demonstrate my own biases in what I was doing in investing. And I knew it. It wasn't like, oh my God, I discovered it 20 years later. I knew it. And I was still doing it. And I can tell you, it was the hardest part of the book to write, to admit to my own bias and stupidity. And that shows you how difficult this is to address.
Oh, yeah. I mean, listen, I really did appreciate that you did with that humble, and you showed the humility to kind of show, to make the point by showing your own mistakes on it. And listen, I'm in the same boat. I mean, I haven't looked at my Coinbase position in around 6 months now. So, that whole, fear about, loss aversion and putting your head in the ground when you have a position start going against you, you just don't look at it. Maybe it'll just get better at some point. So I totally understand that. All right. So why don't we take a slight pivot here away from the investing part here, and something that as a general theme that I kind of pulled away from the book here is that, listen, in our industry, Bob, we know that capitalism is always under some degree of attack from, or under some degree of criticism from a wide group of people here, and you don't hold back. You do highlight several of our industry's not such best days in it. But having said that, though, I still get a strong sense that you remain a steadfast defender of our markets out there. I mean, is that like an accurate statement? I mean, how do you just kind of feel about capitalism, how it's viewed today, and our markets in general?
It was Winston Churchill, I think, who said that democracy was the worst form of political system except for all the others. Well, it's pretty much true. Capitalism is the worst, form of economic system except for all the others. I'm a capitalist for a very simple reason. Have you studied human history? Do you know what changed the world? What changed the world was invention, economic development, and largely that came out of capitalism. And largely, just look around. I mean, it's pretty shocking if you look at estimates of like global output up until about, really the 1700s. Incremental growth in global output, it was just nothing. It's a flat line. All of a sudden you hit into the and particularly the late 1700s, and it starts going up. And then in the mid 1800s, it goes through the roof. Well, what the heck happened? Well, in simply shorthand nomenclature, you could talk about things like the Industrial Revolution, but it was really the development of new forms of producing, new forms of energy, like the steam engine, new forms of economic system, like capitalism, new states that developed after the religious wars of the 1600s, nation states like France and early forms of Germany, wasn't quite Germany we know today, but they developed notions of protecting individuals, protecting property rights. This is when the concept of personal freedom and personal liberty actually came about. This was what we call original liberalism, and people who were writing about these principles are that the primary purpose of the state is to protect the person's life and property. Simply put, that was what came out of the religious wars of the 1600s, which almost destroyed Europe. They got strong nation states that said, we can't fight each other. Individuals need protection. Property needs protection. This is the birth or early forms of capitalism. There was capitalism that existed in Italy during the Renaissance. But my point of this history lesson is look at what happened as a result of this. Economic output went through the roof. Lifespans began to increase. There were improvements in medicine. There were improvements in technology. I think there is a relationship between the economic system we call capitalism and the political system we call democracy. However, people will argue with me about this. They'll say, look at China. Okay, now the Chinese had an enormous leap forward in the 1970s under Deng Xiaoping. These weren't exactly, people believers in democracy. And my answer to that is yes, but Deng Xiaoping increased political liberalism to a certain extent. I think that really helped, but I would agree with the idea you can have capitalism with still an authoritarian state, but I don't think it's as effective. So the short answer is I believe in capitalism despite all of its flaws, because it's the best system we've been presented with to improve the lot of humans. And don't let anybody tell you different, Jim. You're an optimist like me. Things are getting better. Lifespans are getting better. Health is getting better. We have a lot of things we need to work on, but the world seems seized by gloom and doom. And it's, if you really look at a broad swath of statistics, it's not true. And so I'm sticking with the capitalist camp.
Yeah, listen, I do agree. I mean, I don't know how you can stay in this industry or any industry for that long if you don't have like a degree of optimism for the industry that you are in. I don't know how you can have a career for, for 20, 25, 30 plus years on it. So listen, you did kind of touch on that. Capitalism is capitalism. It's not a form of government. We will be down in DC October 12th to 14th for our 89th annual Market Structure Conference. And thank you. I know you're going to be presenting on the Friday morning. Thank you for doing that. So let me just get your thoughts on DC. I mean, if we were able to get every single senator and congressman into that ballroom at the JW Marriott, what are some of the messages or things that you'd want to say to them if you could, get through to them and you had a half hour of time just to talk to them?
People ask me like, what do I worry about most? And I usually surprise people and tell, I don't worry about the stock market that much. I know I'm the stocks correspondent, but I really don't worry about what's the S&P 500 going to do at the end of the year. On a daily basis reporting, I talk about it all the time, but worry is a different thing than reporting. What I really worry about is economic inequality, particularly in the stock market and the bond market. Look, I'm of the opinion that the best way to long-term wealth is investing in the markets and investing in a little bit in the bond market. Owning a home is very important. Having a 401k, having Social Security is important. But we know that long-term stocks are the best investment. I said long-term, okay? So don't write to me saying, we're down this year. Long-term. And it is disturbing to me to see how lopsided ownership is of the stock market. You've seen these statistics, Jim. 10% of the households by net worth control 83% of the stock market wealth. 20% control 93%. I mean, these are scary numbers. I mean, most of the stock market is owned by 10% and completely by 20% of the households in this country. That's terrible. This is why when Robinhood came in like 3 or 4 years ago, and all of a sudden they announced 20 million accounts, I said, my God, that's fantastic. I don't care if they've only got $5,000 in the account. Who put together 20 million, mostly new people? Where did they come from? Thank God they're there, because we need them. We need more people with $5,000 in their accounts that are 25 years old that'll grow to $500,000 20 years from now. We need to start getting those young people involved and teaching them. And that your industry, Jim, is in that business of retaining those 20 million people. And I don't want to get into Robinhood and the managerial mistakes they made. That's a different issue. They had these young people, and hallelujah that they're there. Now, your industry, Jim's got to figure out a way to keep them there. And now we're in this downturn. We don't want them to walk away and say, oh, the market's rigged. It's all, when the market was up, they were geniuses. When the market's down, it's rigged. We want them to stay and to keep them in there. And that's the one thing I would talk about. So making it easier access to 401ks. Brilliant idea to have an automatic opt-in to the 401k. Not you have to push the button to do. Automatic opt-in is one of the most important innovations for behavioral finance in 20 years, because people don't have to think about it too much. And we need better ways of educating people. So your industry, Jim, and people ask me, what's your industry? And you're not in the stock trading industry. You're not even in the retirement industry. I call it the dreams business. The financial business is in the business of making people realize their dreams long term. That's the broader way to look at what kind of business we're in. We're not the stock trading business necessarily. That's just what the daily thing is. But you have to look at it on a broader level. So I'm more ownership of financial assets, broader ownership of financial assets. That's what I want, and that's what worries me.
I mean, listen, I think that one of the messages that we do try to deliver down in DC, and it's not just us, it's other people as well, is that the role of our markets isn't just about capital raising for companies. It is a wealth creation for our nation as well here, and enabling people to link into the marketplace, have tools available to them, have the education, which then gives them the confidence to use those tools to create wealth. It's very important. So obviously I know we don't want to get too far into this thing, but we are seeing companies raising money away from the public markets, and that is kind of contributing to what we just kind of talked about with the wealth kind of being held at the top here. But I do think that there needs to be an understanding that our public markets are really good. They are not just about a company being able to go to the public market and raise capital. It is also about people having access to those public markets and have them being robust and having them have access to these young companies so that they can acquire wealth down the road. It's worked for so long, and for some reason it seems like it's gotten off the tracks a little bit in the past 20 or 30 years, but hopefully we can kind of get it back in here.
Yeah, and you just mentioned private markets. We need to make it easier for people to go public. It is disgraceful that we have so many companies sitting there private for 5, 10 years. They're being fed, well, they were being fed by low interest rates and venture funds that are willing to keep them private for a long time. But this means the vast swath of the public doesn't get to participate in companies until they're middle-aged. Right. Well, that's terrible. This is like it's not a mafia. I don't want to mean it in that way, but it's like a small group of people have captured all the early stage wealth of these companies, and there's something wrong with that. It makes me furious, frankly.
I'm with you. I totally agree. So, listen, we have time for one last question here, Bob. So, what are you hoping readers take away after they finish reading "Shut Up and Keep Talking"? What are you hoping that they kind of take away? What are some of the messages that you kind of hope they?
The most important thing. I'm a Jack Bogle disciple. There was one guy, when you start thinking about what your career is like, who influenced you the most, the one guy was meeting Jack Bogle in the mid-1990s, the founder of Vanguard. He changed my life, and he absolutely insisted on principles that are still true today. One is be a long-term investor, and that means don't do market timing. Don't think that I'm going to go in now and then I'm going to go out now, because the academic evidence is nobody does it well. You have to be right going in and you have to be right going out, and nobody gets it right. It's too difficult. So staying with the market is really the best long-term kind of advice. The other thing is don't make mistakes about how long you're going to live or what your risk tolerance is. People say, well, understand what your risk tolerance is. So when you're 65 years old, you're going to want to lighten up on stocks and buy more bonds. I'm not sure that's so true. Most people in my age group, I'm my late 60s, we're going to live to 90. If we hit 65 years old and all of a sudden start selling stocks, you're going to be living for another 25 years. I don't know about that. Think of it this way. You have three basic buckets here. You have number one, Social Security. Number two, you have your house. Most people own their house. And number three, you've got your private savings. Some people have pensions. There'd be a fourth bucket. But your private savings, I'm talking about your personally, like your 401k type. If you think of those three buckets, so pick a number. Your house might be worth $250,000. What's the Social Security stream worth? Well, people get $20,000 a year over 25 years. That's, do the math there. That's $500,000. And what do you got in your 401k? I don't know, pick a number. 250,000, 500,000. But think of those three buckets together. And people say, oh, I got too much risk in stocks. Not if you look at it that way. Not if you look at what government, Social Security's paying you. You got a house that's worth something there. And then you've got your private investments there. And I think the big mistake people are making is that people should have a higher risk tolerance than they actually think they say they have. And if you explain it to them that way, they say, you're 65, you're selling your stocks. Because why? Because you think the market's too volatile? You're going to live to 90. 25 years from now, what happened this month is not going to matter. Trust me, it won't. So I hate to start pushing investment advice on people, but I really see that kind of mistake that people are making. So the book's a little bit about some famous anecdotes. I talk about what I learned talking to Aretha Franklin. She came down here. Some people like Walter Cronkite came down here in 1999, had some amazing things. Barry Manilow came down here a few years ago. I'm not a Barry Manilow fan. I was shocked at how sage he was about his own career. I was just talking to him quietly on the sidelines, and he had sold out the Nassau Coliseum, 15,000 people. I said, how do you do it? And he talked to me about the arc of his career and how he had big hits in the beginning, and then the hits sort of stopped coming, but he kept doing what he liked doing, kept producing albums and the music that he loved, and he just kept at it. And now people are calling him a legend. They're selling out because they're calling Barry Manilow a legend. And he was just it wasn't terribly brilliant, but he got to the point. His point was, in the mid part of your career, that's when it gets hard. When all of a sudden you say, I don't want to do this anymore, and I keep going. And the people really love it. They stay at it. And eventually you require great wisdom and depth of knowledge, and people start calling you legends. I kind of did this myself. I was thinking of doing something else after 9/11, and I stayed. And what happens is, like you do, Jim, you become inch wide and mile deep. You become very well known for a little part of the world, in my case called the stock market, in your case, financial services industry and the trading industry. And you emerge on the other side. You're kind of like, you write a book. That's what happens. So I thought Barry Manilow was just really interesting to talk to. So I described a little bit of chapter in the book.
Yeah, I got to tell you, and I remember that part of the book. It was good, and it does kind of, we always tell like the kids coming out of college to find something that you enjoy doing. It's hard, obviously, kids coming out to kind of take that path. They want to get some financial independence, but it's important, I think, for us as adults to find that as well, because if we do find something that we do enjoy, we are going to stay with it longer. And in this game, not this game, but in our industry, you're in it until you kind of take yourself out of it. So stay with it, find some joy in it. And I'm going to wrap it up here, but I got to tell you, you kind of touched on like the love that you have for the industry on it, and that does come through in the book, and also in kind of what you do day to day. And I just want to thank you. I do feel like as a former trader, I do feel you are a very strong advocate for our role and the important role that enhanced liquidity providers provide in this marketplace. Obviously, it looks very different today than it did look in 1980 and 1990 and 2005. But I always feel like you are always in our corner, and for that, I just want to say thank you. And I'm greatly looking forward to you joining us in DC this October.
Thank you, Jim, and I very much appreciate your friendship and being a part of Security Traders Association for all these years.
Okay, Bob. Well, Bob, that's a wrap.
Thank you.